Christi, I have a question for you. What do you think about when you get that call from a client or a friend, even if you see them at a cocktail party or something like that, and they want to talk about the hottest new stock? What goes through your head when that happens?
I hear that all the time. And I think trying to give a tip on a stock, especially at a family gathering, isn't always a good idea. And I think they need to look at the bigger picture of things. But it happens all the time.
You're exactly right. And I do think that's one of the reasons I was thinking this episode was so important, is because people sometimes lose focus on the big picture.
It's the wrong question. What's the best stock pick? Even though we think it would be the right question.
That's absolutely true.
So welcome back to Mind Your Money with myself, Christine Wiskachel, and my business partner and friend, Jerry Jarzabek, where we break down real financial concepts and investment ideas in a way that actually makes sense for everyone.
And today we're talking about a concept that I think is critical for investors. It's something that isn't very exciting, but really determines how well you're going to do on your portfolio and your investments, especially over the long term. And we're talking about diversification.
And asset allocation today.
Before we get into this, let's start at the beginning. As we said, we're going to try to keep this podcast very relatable and not get too caught up in jargon, those type of things. But we probably should start off by defining what is an asset, just as a broad definition.
That's a great point to start at. So an asset is something that has value and will provide you future benefits. Most people are thinking of assets as just stocks, bonds, and everything else like real estate and crypto. But there's a lot more to an asset and how you can find the right one to invest in. And we'll talk more about that today.
Yeah, I think you're exactly right. I think that's the basic diversification or asset allocation that we're talking about is stocks, bonds, cash, and then other, so to speak, those other different types of asset classes that you can own in your portfolio.
So I think where we could start is, what are stocks?
So stocks, very simply, are an ownership in a company. So when you buy a stock, you're actually buying ownership in that company. So if you think about being an owner of a company, even though there's going to be lots of other additional owners in that company, especially if you talk about large companies, you have all the benefits, but also risks that come from being an owner in a company.
So I think that is really important to point out that with a stock, you have much more higher upside potential, but you also could have more volatility, which we did talk about in the last podcast, Jerry.
Yeah, that's exactly right. So for stock, you have a higher upside potential. You can make more money on your investments, but you also have more risk. So the more volatility. You can have more fluctuations in the value of your investment. And if things don't go well, you could unfortunately lose money in a stock.
And one of the reasons to own a stock is, as you said, ownership, capital appreciation, and dividends. So let's also go into a little bit about the other type of investment we see is bonds. Why should someone own bonds? And what exactly is a bond, Jerry?
So if you think about stocks as ownership in a company, bonds are lending money to a company. So you don't become an owner. So you're not going to participate in the growth of that business. You're not going to have the upside potential that you have in stocks. But like any type of loan, the company is going to pay you back over time, and you're going to earn that dividend. It's going to be on an agreed upon interest rate when you first invest in the bond, and you're going to receive that over time. And at the end of the agreed upon term, you're going to receive your principal back. So because of this, bonds are historically much more stable than stocks.
Absolutely. So it really is, when we're talking about stocks versus bonds and other investments, the risk, some are riskier than others, but also the trade-off that you have with potentially having more earnings or more growth out of a stock than a bond. So I really think too, higher returns obviously can give you higher risk.
Yeah. So that's the whole trade-off is the more money you put in stocks, potentially you're going to have more return, but you're also going to have higher volatility and risk. The more money you put in bonds, you're going to have more stability, and you're going to have a good, consistent cash flow from the interest that those bonds pay, but you're going to give up some of that growth potential. So really, diversification is all about finding that balance.
And I think we're going to share with the listeners a handful of slides that give you some more detail on what we're talking about today. So when we're talking about the risk to bonds, again, inflation risk and interest rate risk, correct, Jerry? And there are some different points to add to that. Even though it's a bond and it's safer, there always is some risk in any investment. We have to disclose that and share that with you.
Yeah, that's a good point. And really, the worst case scenario for both a stock and a bond is really if the business is not able to continue. That would be really bad, and we want to avoid that as much as possible. And that's another reason why diversification is so important. And the idea is not putting all your eggs in one basket, because if you overinvest and you put too much money into one stock or even one bond, and then that company runs into trouble, you could really put your portfolio at risk.
That's a really good point. And I'd add to that, every investment is going to perform differently at different times of the year. So currently we're in a great stock market. The stock market's been doing really well. We had a time a few years ago where our bonds were not doing as well because of obviously where interest rates are. So it's important when we're thinking about the diversification to know too that combining those two, like we're talking about with stocks and bonds, helps kind of smooths out that ride, in remembering that those two are in an inverse relationship. So it's helpful having both and knowing the right balance for yourself of how much you want to have in stocks and bonds. And that's when we'll get into some more detailed conversations in the next podcast to talk a little bit more about what kind of mix is important at what age and what time of your life you're going through where it makes sense.
So, Christi, I think at this point, it makes so much sense that you should be diversified. You should have stocks and bonds and other assets in your portfolio. You shouldn't put all your eggs in one basket. We've all heard that many times. So why is it that it's so difficult for even experienced investors to stick to the plan?
I think people struggle with seeing, which sometimes I do, the shiny object. I think about right now in the stock market, we had the largest IPO just came out with SpaceX. So we've gotten those calls of, should we buy now? We need to buy? This is the hot new stock. Right now, there's a lot of buzz around AI and technology stocks. So I think people maybe get in the moment, which is natural and normal, instead of struggling with their financial plan or the big picture. And that's why, again, we go back to the diversification, because you can't always chase that stock. If you think about it, if it's a big hot new stock, it's mostly likely at a higher price. So making sure you're really watching that and balancing that.
So I think one of the things we're going to do at this point is, and I think this will be really helpful for us, even though we've been at this for quite a while now, even for our experienced investors that are listening, for our newer investors, we welcome everybody. We want to make sure everybody gets some good value from the time you spend with us. But this is one graph that I thought was excellent and talks about increased returns come with increased risk. And what this graph shows, so if you're watching us, you'll be able to see this. It'll also be in the show notes, or you can reach out to us for any of these charts and graphs. But it simply shows that the more money you put into stocks in your portfolio, the better your historic returns can be. But you also have to be prepared for that increased volatility, and vice versa. The more money you put into bonds, the safer it will be, and you will have less volatility historically, but you're going to accept much lower returns for doing that.
Absolutely. And I think also when we're speaking of that over time, how much time matters, another slide or some more information we're going to share is the long-term perspective and the asset class diversification. I call it the window pane. So you can see all the different types of investments and over time how they do. So the slide that is long-term perspective is important. It really does show historical returns over time, which Jerry just talked about. Best, worst, and average returns. And really that staying invested is the key, and really watching that allocation. And you can see in that the 1 year, the 3 year, and the 5 year, even when the market does terrible, or we have a 50-50 portfolio, how it's much easier to come back from that when you have it diversified appropriately. So I thought that was a really important slide to share about the historical returns with those allocations too.
I agree with that. It talks about how long-term perspective is important, but also knowing yourself. Mm-hmm. Meaning there are some clients that we work with where they truly can handle the volatility. So they can put more money in stocks, and they're not going to be as concerned when they get a monthly statement or two and there's a large disparity in the value, right? They have a couple bad months in a row and they see their portfolio drop dramatically. But a lot of investors can't handle that as well, and it causes them a lot of anxiety.
And that's a good point. So the asset allocation, how you're dividing your investments, your advisor, or knowing yourself. If at night, if you wake up the next morning and we have had a bad day in the market, how do you feel about that? You really have to have those conversations we do with our clients, but you have to have that internal conversation with yourself too. That helps you, obviously, how long you've been investing, your investing experience helps you determine that asset allocation too, I think.
That's absolutely correct. I think about it and also you have to extend your time horizon. So, and this is a very personal decision, asset allocation, mm-hmm. diversification. There is no one size approach that fits everybody, meaning your asset allocation is going to be unique to you. Mm-hmm. You may have a slightly different amount in stocks than your neighbor who lives in a very similar house to you, has a very similar income, but yet they may want a portfolio that's different than yours. And I think that's something that we work very hard at, making sure our clients have a portfolio that's very much tailored towards them.
Agreed. And really kind of final insights is making sure as a successful investor, you stay consistent. It's not about that flashy new stock that came out, and really having that conversation with your advisor. And I'm going to ask Jerry too, we were talking about time horizon, diversification, if I think about the 3 takeaways for the listener today, what would those 3 be that you think are really important for them to really focus on after today's talk?
I think number one, it's not about picking the perfect investment or the hottest stock. I mean, that is a very simple takeaway, and it's something we've learned and a lot of time it's almost FOMO, fear of missing out. I mean, you're going to talk to a friend or a neighbor or see on the news about a certain area of the market or a certain stock that is just doing so well that you're going to feel like you have to rush in there, and you're going to need to get more and more of this investment in that category. And often, once so many people have jumped into it, it's almost like that category is peaked or is near a peak.
They're trying to time the market. So that was another takeaway that I got out of this, was being consistent with your investments and not trying to time the market.
Oh, absolutely. And then this is the bottom line of this whole episode and why diversification is so important. When you step back and you look at how you did over a longer time period, most of your return is going to actually be determined by your asset allocation and the diversification that you had. So if you're somebody that was able to stomach the volatility and keep more in stocks, you will probably do better over those 20 years or 30 years, etc. But if that volatility is something you're not going to be able to stick with, then having the diversification, having bonds in there and cash and those other asset classes to smooth out the ride, it's going to be critical. It's going to
help you stay in the market and not, I'd say, panic or pull out when you shouldn't by having that. I think this was a great episode, Jerry. I really enjoyed it. And I want to share with you guys, if you know someone that this would be helpful for, please share it with someone that could benefit. Introduce them to Jerry and myself. We're always welcome to conversations with someone that would want to learn more about what we do for our clients.
Yeah, absolutely. Thank you for everybody that's given us great feedback and giving us ideas for topics and those type of things. We look forward to seeing you next episode. So I think we can give them a little preview. What do you think?
Yes, we talked about it today.
Yeah, so I think in the next episode, we're going to kind of bring together some of these concepts, and we're going to focus more on retirement income planning. So maybe for the newer investors, it won't be as hot of a topic, but it's critical to what we do for our clients. And we think people that tune in for the next episode are going to get a lot of value out of it.
And I think people, too, are sometimes think that when you want to retire, you should start planning at 60. It's important to start now. So it really isn't a bad conversation to even have with those younger investors, because setting yourself up for success in retirement, whether it's your parents or grandparents, is really important.
Absolutely.
Jerry, after talking today about diversification in asset class, I think maybe we missed a little detail, and I wanted to ask you about what we call in the business the window pane.
Well, I appreciate you giving me a few minutes extra to talk about this. I do think this is pretty important. So back when I was starting my career, and this goes, as you know, 30 years ago, we used to refer to this as a stained glass window sheet.
What did I call it? A window pane?
Well, window pane, but no, that's exactly right. That's why it has that name, is because if you're looking at it, we're going to put it on the screen now. But if you're listening to us, what this does, and there's different versions of this that go back, different amounts of years. But what it simply does is it shows you each year what category of investment was the best performer that year, down to which was the worst performer that last year. And then it color coordinates them. So it'll have large cap stocks, bonds, and it can get very detailed even within those categories. So it can have different types of bonds, cash, etc. And when you step back and look at it over a 20-year period, how does it begin to look?
It's really just an up and down, but it's pretty even keel, because you're getting that return through multiple sources of the market.
That's right. So there's a couple things you see on that, right? Mm-hmm. When you look at it, is number one, no category is the best performer consistently year over year. As things change, something will be the best performer, and then the next year it might not be the best performer. So you see that happen. But you also notice, and this is what I think you're referring to, is that if you have a good mix of all of the different categories, you avoid those huge ups and huge downs.
The equal blend, I think, is what I was thinking about, the equal blend of asset classes.
It can be much more consistent. So, and then the main reason we call it the stained glass window sheet is because you make all of those different categories, different colors, and you step back and look at it, and it actually almost looks like a stained glass window, because there's so much randomness in where all the colors are put.
And we've seen it in the last handful of years where the large cap growth has done really well. And now we're starting to see with some of the changes with whether it's the tax laws, smaller and mid cap areas are doing better. So currently right now, that's an area that we're seeing change within that diversification shift, correct?
Yeah, I think you're absolutely right. So that was just a quick bonus segment. So thanks for letting me do that, Christi, and thanks for sticking around to hear that extra minute or two.
Don't throw any baseballs at this stained glass window, though.
Don't throw any baseballs, but the good part is that if you hit one of the panes,
yes,
it should break just that pane and not break the whole window, which is what you want your asset allocation to do for you. Meaning, if one of your categories turns out to be a dud and then not do well, you'll have other things in your portfolio that'll take up the slack for that investment. So that was a lot in this one chart.
No, that was great. Thank you for giving us a little more detail on that.
Great. See you next time.
This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and is not a complete analysis of every material fact regarding any company, industry, or security and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. The information has been obtained from sources considered reliable, but its accuracy is not guaranteed. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. Baird is not a legal or tax service provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. Investors should consider the investment objectives, risks, charges, and expenses of each fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. This broadcast may not be reproduced without express permission of Baird. Robert W. Baird & Company Incorporated is a registered broker-dealer and investment advisory number, member of FINRA and SIPC.